Hello, everybody. Ed Yardeni here at back home, June 15th. It's a Monday, 11 o'clock a.m. New York time. That is not Max. That is Bailey. Bailey's made a guest appearance, and as you can see, she's very excited to be here. She's not often joining us, but she is here today. I will warn you, she snores, but I've got a Yeti microphone, which I think blocks out background noise. So if it gets to be a little bit noisy in the back there, let me know, and I'll ask Bailey to leave. But she looks pretty comfortable. Anyways, we had a very comfortable trip in Crete and Santorini, my wife and I, over the past week. Got back Saturday night. I was a little bit nervous about whether we would be able to get back. Not too nervous, but I was somewhat concerned that there wouldn't be enough jet fuel to get us back, and never was an issue. So far, now with the war apparently coming to an end, looks like there's plenty of jet fuel to bring back tourists to whatever destination they want to come back to. But we had no problems flying there or flying back. The airports were packed. Athens was packed. JFK was packed. We did talk to the locals in Crete and Santorini. Just kind of asked them, the shop owners and taxi drivers, about tourism, and they said the tourism is down in Crete and Santorini, and they blamed it on the war. That it got a lot of people kind of nervous about traveling. Maybe not as many people were as adventurous as we were, willing to take a chance that we'd run out of jet fuel and couldn't come back. Of course, it's not the worst thing that could happen if you go to Greece and you can't get back home for a while. Anyways, I had my laptop and I did do some work. Toby and Elias chipped in more than usual on the morning on the quick take, so that helped. But I obviously read these things and edit them and kind of put them in our style. They're still kind of learning the ropes, but they're learning them very, very quickly, I must say. Elias joined us about at the same time as Toby did. Elias is stationed and lives in Amsterdam, and Toby lives in Melbourne. And then maybe a year ago, William Pesek joined us, and he's in Tokyo. So I guess we're a global firm based on the location of where people are that are working with us and our team. And basically, we're open 24 by 7. So it's fun, it's interesting, and we've certainly broadened our research capabilities in terms of what we do to look at the global economy, global financial markets, forward earnings on a global basis, and geopolitics and so on. Well, speaking of so on, the bull market carries on, and once again we've had a stress test of the economy, of the bull market, and the stress test has been passed so far remarkably well. Remember the list? We started out the decade with a pandemic, the lockdowns. The lockdowns led to supply chain disruptions because of the pandemic. Supply chain disruptions led to inflation. Russia invaded Ukraine. That led to more inflation. Central banks realized that they had to raise interest rates, which they did. There was a lot of fear that that would cause a recession, particularly in 2022. We had a bear market. It didn't last that long. It was pretty conventional, 9 months, 25% drop, but there was no recession. Back then, I was talking about the most widely anticipated recession of all times. It just wasn't happening. And we were early on the resilience of the economy. We were early on the resilience of consumer spending. But that's partly because we staked out the roaring 2020s narrative back in August of 2020. Once we sort of said, this could be a pretty good decade for the economy and the stock market, that kind of kept making us look for signs that that was, in fact, panning out. So we took the optimistic side, very well aware of what could go wrong, and the pessimistic side as well. I have to once again thank the perma bears for doing all this great research on what could go wrong. Help saves me a lot of time, so I can focus on what could go wrong with their forecast of what could go wrong. Well, anyways, so what else did we get? Oh, we had remember that little mini banking crisis we had in 2023. Then we had the Trump's tariffs last year. We have the war this year, and real GDP is an all-time record high in the U.S. Stock market is almost back to its all-time record high. Uh, the war presented a pretty good buying opportunity that didn't really last very long. And I thought there might be a June swoon, if nothing else, it kind of rhymes. But the thought was that, especially after what we saw on June 5th. Remember, on June 5th, the payroll employment numbers came out. They were very strong for the third month in a row. And then the market started to price in rate hikes instead of rate cuts. However, the rate hikes the probabilities are scheduled for later this year and or early next year. And we thought that there's a reasonable likelihood, given the strength of the economy, given that the oil shock is having some inflationary consequences, at least on the headline numbers. And at the same time, remember that let's keep in mind that the point we made about Trump's tariffs, people, the some said that the tariffs wouldn't have and had no impact on inflation, and we disagreed with that. We said, well, wait a second, you have to look at what might have happened if the tariffs thing never happened, and I think we were on course to get down to 2% on the headline and core CPI and PCED. We could have done that last year, but the tariffs, there's no doubt about it. When you look at the charts, there's no doubt that durable goods inflation definitely picked up, and that had to be tariff related. And durable goods inflation continued to be a problem right until a couple of months ago. Now, in the latest May data, there's some indications that that's maybe played itself out and it's not having the inflationary consequences that it had for the past year or so. But so the tariffs, what they did is they didn't boost inflation; they just kept it from going lower. I hope you get that nuance. It's pretty straightforward, I think. So we would have been at 2% by now if it hadn't been for the tariffs. And then, of course, we got the war and another oil spike. But this oil spike is reminiscent of what we had in 2022 when Russia invaded Ukraine. But there are some significant differences. The supply chain disruptions aren't as significant now as what we had back in 21, 22, when the pandemic definitely affected global supply chains all around, globally, all around the world. And so this time around, the shutting off of the Strait of Hormuz has also had some disruptive impacts on supply chains. A lot of fretting about the availability of helium. I don't think it was people worrying about whether they could get helium balloons for their kids' birthday parties. It was concern that helium is used for manufacturing semiconductors. It turns out that you talk to some of the companies that manufacture gas and provide gas, put it in containers and all that. There never really was a serious problem along those lines. Then there's the fertilizer issue, and that is maybe going to have repercussions on food, though. It's interesting that agricultural prices, particularly grain prices, are falling. with this news that the war in the Middle East may in fact be over. But all in all, not only has the economy been resilient, the consumer has been resilient, but as a result of that, earnings have been fabulous. Fabulous earnings momentum is what I call it, and that's FIMO, not to be confused with FOMO. Let's look at some of the latest FIMO numbers here, which is what's driving the market. Oh, so I was saying, so I thought there might be a June soon. I was kind of hoping there'd be a buying opportunity, but saying this market doesn't want to give us buying opportunities anymore. Uh, Speaking of buying opportunities, my broker called me up a couple of times over the past few weeks and asked me if I had any interest in participating in this SpaceX IPO. I said, yeah, I think so. Maybe like 1,000 shares. I figured, it's kind of with Goldman and Morgan Stanley, it would be well managed, and there'd probably be a kind of a good gain in it. Well, I went on vacation. I really didn't want to be focusing on the market. And besides, when I invest my own money, I tend to invest in ETFs. I don't want to really kind of get distracted from my job by looking at individual stocks. And SpaceX is such a controversial, important, maybe life-changing company that I wanted to be able to maintain my objectivity. My objectivity right now tells me that get me 5 minutes with Musk, and I'll tell him there's really no reason to go to Mars. There's absolutely nothing there. There's no reason to put data centers in outer space. They'll probably get hit by space junk. Put them in the ocean floor. I saw on LinkedIn an article saying that the Chinese were putting these things in the ocean floor. And by the way, not related to SpaceX, I would advise Tesla, his company, to manufacture hybrids. Anyways, I got that off my chest. I feel much better now. But the SpaceX went well, very well managed, obviously. Then any concerns about the Fed have been somewhat reduced by the better than expected core inflation numbers we got for the PPI and the CPI, and just kind of a sense that when the FOMC sends out its statement on Wednesday, the perception is that it may not be biased towards easing, but it might be biased into a neutral stance. We're still kind of holding on to the idea that it might actually be biased towards a tightening stance. And that's because, the Fed hasn't gotten its target right. Its target is 2%. They've been above that for 5 years now. And so from that perspective, the Fed hasn't been restrictive enough. This rebound in inflation, at least on a short-term basis, lowers the real Fed funds rate. More importantly, Elias and I have been thinking that with all the AI capital spending boosting the economy, with the consumers, particularly retiring baby boomers, relying on their $89 trillion of retirement assets, that real GDP growth is more solid, and therefore the real Fed funds rate, the normal or neutral Fed funds rate at which all this can happen, is actually higher than otherwise would be the case. If that's so, then the Fed funds rate, the actual Fed funds rate, isn't really even slightly restrictive. It might be actually a bit too easy, and I think that's kind of confirmed by the fact of the way the stock market's been roaring to the upside. But again, let's go look at some charts here. So we'll share, and we'll go to, let's start out with the Fed. So Elias and I went through the Hawks versus Doves debate at the Fed. And admittedly, there's a lot that the Doves can point to. And of course, one of the key Doves is the new Fed Chair, Kevin Warsh. And here we have the oil price spike back in 2022. Inflation was already going up back then on supply chain disruptions. This time around, inflation was moderate and looked like it was continuing to head in the right direction towards 2% over the next couple of years. That's what was in the summary of economic projections by the Fed. This time around, we didn't get up to 150 to 200, which some people were fretting about. Even a couple of weeks ago, I kind of flinched after listening to what the head of some top officials at Exxon and at Chevron were saying, and they were saying that if this war doesn't end soon, the price is going to go up to $150 because inventories were getting right down at the bottom of literally right down to the bottom of the barrel. Well, it looks like the war's over, and looks like there were some other factors at play here. It looks like the Chinese weren't needing as much oil as people thought. The economy is weak. They also have a lot of strategic reserves piled up. And all in all, it was really quite amazing given the news that was going on back here that we only spiked up twice to about 118. And now, as of Friday, we're down to 87, and obviously even lower than that today. So that reduces the inflation concerns that we'd all have if this thing just remained around 100. We're already starting to see that gasoline futures prices are coming down. That means that the national retail price is going to come down, and then the CPI gasoline should come down. Again, one big difference between now and 21, 22 is wage price spiral. Back here, the labor market was very tight. Wage inflation using average hourly earnings or using the employment cost index. We saw inflation going up a lot. Then inflation came down. Wage inflation came down quite a bit. So we're not looking like what we had back here with a wage price spiral. By the way, this is a chart of demand versus supply in the labor market, and we remain in a fairly tight equilibrium. And if you take labor demand minus labor supply, you get this series, okay? And then we, on that, put the wage growth tracker, which we actually like better than the average hourly earnings. Average hourly earnings is sensitive to the composition of labor, as we saw back here, when a lot of low-wage workers lost their jobs. Average hourly earnings spiked up because there were a lot more people who were in the high wage area of the labor market, and so that what did not adjust for the composition. The wage growth tracker does account for the composition, and you can see that demand and supply are kind of in equilibrium, and maybe demand is starting to grow faster than supply, and maybe that'll put some upward pressure on wages, but for the here and now, that's not the case. Another concern that the Fed has is not only wage price spirals, kind of taking a supply shock like an oil price spike and worrying that it'll spread to the other prices in the economy, is not only a wage price spiral, but also whether inflation expectations are well anchored. And here's the 1 year ahead from the FRB New York Consumer Survey, and you can see it shot up pretty dramatically here. Even the 3 year went up, but so far so good. This is pretty calm, so that's good news. Unit labor costs, we've been saying a lot about that this time around there's even less. Look at here, unit labor costs back here did shoot up as wages rose quite sharply, and productivity did not offset that very much. Now we've got productivity offsetting wages, and you can see that unit labor costs are down to 0.5% on a year-over-year basis. So the wage growth tracker again. This is the wage growth tracker job stayers versus job switchers. And you can see that there isn't much incentive to switch jobs these days. You don't really get much of a pay boost. So what's the reason for even thinking that they might go for a tightening bias? There's the quaint thing about the mandate. The dual mandate says that they want to keep the unemployment rate down and inflation down. And now the risks clearly are more on the inflation side than they are on the unemployment rate side. So now if the risks were sort of in balance, neutral might be the right stance. But given that we still have some inflationary pressures working through the system, maybe that's not the case. And again, the Fed officials, most of them recall that they made a mistake in 2021, 2022, and that is maybe not moving fast enough in 2022 to raise interest rates. And so they had this idea that inflation was transitory. They started to recognize it might be persistent, and then they acted quickly to raise rates, and then inflation came down. They may have those same kind of concerns. I mean, I don't really think the Fed is as almighty as they think it is. And I think a lot of these things happen. Inflation is just not, in my mind, not just a monetary phenomenon. But as long as they think so, we have to kind of think the way they do. And they may be thinking that if they don't indicate that they're willing to tighten in the face of a tight labor market with some inflationary pressures, that'll affect inflationary psychology. Meanwhile, as I said, Elias and I thought about it, and with inflation higher than it had been, then the real rate, the real Fed funds rate has actually gone down. While meanwhile, the neutral federal funds rate at which we get nirvana in the economy, that's gone up because of AI capital spending. And by the way, AI capital spending, we agree that it's a productivity enhancer and that it's going to lower inflation. But for the here and now, AI capital spending is actually quite inflationary. It's boosted commodity prices, it's boosted electricity prices. And when you look at the CPI and PPI on the kind of hardware side, computers and semiconductors, well, we all know those prices have gone up. Meanwhile, the 10-year and the 2-year, I don't have the 2-year here, but the 10 years the same thing. The 10 years saying that the Fed should be raising interest rates. And if they don't, then if they indicate that they're buying into Warsh's idea that no need to worry about inflation, productivity is going to make a difference, the bond market bond yields may go up on fears that the Fed isn't being vigilant enough. Labor market is tightening from the supply side. This is what's going on with the growth rate of labor force of people who are foreign born. Obviously, a lot of that has to do with the administration's immigration policies. People like me, I'm still working for a living. I don't play golf, so I don't know what I do myself with it, but I didn't do this. And besides, it's a lot of fun. But as you can see, the participation rate of 55 years and older, that's been coming down, especially of men, and that reflects retirement. So the supply of labor is tightening. The demand seems to be picking up, and that increases the chances that maybe wages will start moving up. I think the other compelling argument, the most compelling argument, is that the inflation rate has been above 2% for 5 years. The Fed hasn't been particularly successful at all in getting to their target. Maybe monetary policy is not as easy to, doesn't have as much of an impact on the economy and inflation as Fed officials like to believe. But if that's the way they believe, we got to go with what they're doing. But super core is something that we can thank Fed Chair Jerome Powell for coming up with. And super core inflation just seems to be stuck here around 3.5%. and that's well above what we had back before the pandemic. A couple of more things here. Let's look at FIMO, the earnings story. I think that's it. Yeah, this is the U.S. market call. We now have a U.S. global call again with Elias and Toby and the rest of our team. We're pretty well staffed now and able to cover even more than we had in the past. Hope you all see that. But speaking of SpaceX, 75 billion is what was raised, and a market where just the Wilshire 5000, not the entire market, is $74 trillion. So they raised 75 billion. Of course, that number is kind of the entry price, the entry funds raised by SpaceX, because at some point here there'll be a lot more stock that will be sold in the marketplace. But still, this explains why things. Let me just do this. Why things went so well. So this we've looked at before. We were actually in a bear market in crude oil until the war started, and sure feels as though we could be surprised to the downside. I'm already surprised to the downside, given all the talk about all the infrastructure that has been weakened, and that there's going to be a lot of demand to increase strategic petroleum reserves again. But on the earnings side, speaking of SpaceX again, it kind of shot right back up here, and here we have. I'm sorry, I should have turned that off. Okay, this is a very smooth production, as you can see. Anyways, this is long-term earnings growth, and you can see long-term earnings growth kind of shot up here to 24%. That's annual. That's an annual rate, and it's obviously Looney Tune. So maybe if you want to be concerned about FIMO, fabulous earnings momentum, maybe it's too fabulous. Maybe your analysts are getting a little bit too heady about what can be accomplished. I mean, the likelihood that we'll have 24% earnings growth in the S&P 500 every year for the next 3 to 5 years is about as likely as we're going to have get to Mars over that period. And by the way, Elon, there's nothing there. Okay, forward earnings are something that's maybe more realistic. As we can see that forward earnings are up to $366 a share, all-time record high. The analyst expectations for 2027 just keeps marching higher and higher. 2026 higher and higher. That's FIMO. More FIMO here. FIMO S&P 500 forward earnings, the 400 and the 600, all at record highs. Maybe I can declare some victory on the June swoon. I'm going to take credit for June swoon on one day there, on June the June 5th date, when the market was down over 2.5% and stronger than expected payroll employment, which got everybody kind of thinking more along our lines that there's more of a problem with inflation. Sorry, that there's that the Fed might actually be going on a tightening course. There's another swoon here. This is the Magnificent Seven mags divided by the impressive 493, and I kind of view this June swoon as more of a rotation than a correction, and I think it may still be going on here. You can see this in the growth rates of the ETFs year to date. XMAG is up 12.6, S&P 500 8.6, and then minus 1.6. I guess that's kind of covers probably more than you wanted me to cover, but hopefully I covered what you're interested in. So let me take a couple of questions here. David, does LTEG include unrealized gains of securities the companies own? No, it doesn't. LTEG is totally a survey notion. I think it's Thomson Reuters basically gets from analysts what they what they think earnings are going to do. I mean, clearly, some analysts may be factoring in capital gains in stock portfolios the companies own, but that's such a recent development. I kind of doubt that any analyst is putting that into their Excel spreadsheet. So no, I think it's just when analysts look at their companies individually, they can see moonshots, and when you put all those moonshots together, you get a moonshot that just doesn't make any sense. So I'd say there is some sign of irrational exuberance on the earnings side. Usually, irrational exuberance describes what's happening on the earnings side, on the PE side. Chip, note that the reality of a defanged Iran now seems apparent when you combine that with the Abraham Accords and the reestablishment of the U.S. as a predominant military superpower. Doesn't that ratchet up the Roaring Twenties secular narrative a notch going forward? Chip, I'll take any argument that supports our Roaring 2020s scenario. That kind of works for me. But I don't need the U.S. to be a superpower all I really need is for the economy to continue to grow without a recession and the stock market to get to 10,000 by the end of the decade, by the end of 2029. And remember, if you just use your fingers to count, we are 7 years into the Roaring 2020s. By the end of the year, I'm just going to have to get 3 more years right. And the way things are going, I'm starting to wonder whether 10,000 might occur before 2029. I'll take one more question here from Kevin. Before the peace agreement, gold took a hit. Either central banks reduced buying or sold gold to support things like a country currency or pay for the higher oil prices. I know you said if gold drops below 4K, you will reconsider your stand. Yeah, actually, no, we said that 4K was the magic number, and a couple of days ago we said that I think we got down to like 4,100. We said that that's close enough, and that might very well have been a important support. So if you look at let's go back here to the okay. So here's the this, by the way, is on the website, the quick takes. If you go here to the peace dividend one on the global side, this is what we showed this actually, I think on Sunday. But I was looking at this chart a couple of days ago, and I said, okay, we've broken through the 200 days, so there's more downside. Next stop is 4,000, and if it holds that, that's probably a buying opportunity. And so far, so good. So I wasn't saying that if we drop below 4,000, I was saying if we drop below 4,000, then it's going still lower. But I was counting on this channel to hold. This channel is extremely scientific. I took a ruler and drew it here. At least I did that with the computer, and it's working pretty well so far. All right, have a great week. Lots of fun, lots of interesting things going on in our business. I hope you're doing extremely well in the market, and we'll be back next week. Thank you.